Hello everyone, this is Jason Mayer from Sprott Asset Management. I'm going to go through a couple of slides that detail the fundamentals of both gold bullion and gold equities and obviously an outlook on where we think things are headed. The first thing I like to start with is to discuss how gold bullion has performed on an absolute basis. There are many misconceptions out there, and one of them being that gold bullion has struggled from a performance standpoint. As you can see on slide 7, we look at gold bullion as a currency alternative, and you can see how it's done in various currencies. And for the most part, there's much more green on this slide than there is red. And granted, 2013 was a wipeout year, regardless of what currency you own gold bullion in. And as a reminder, the Fed was withdrawing QE. And I think at that point in time, the market had been expecting runaway inflation. And because it had not materialized, the market decided to sell off gold bullion. But outside of that, like I said, there's a lot more positive years than negative years. We live in Canada. And if you look at the Canadian dollar experience, since 2005, there's been only one negative year. And you can see how gold has performed over the longer term with the 10-year returns at the bottom. The other thing that we like to address right out of the gate is this misconception that seems to prevail in the market, which is if the Fed embarks on an interest rate hike cycle, that gold bullion is going to underperform. And this is categorically incorrect in historical context. If you look, moving on to slide 8, taking a look at the previous rate hike cycle, which spanned from June 2004 to June 2006. Rates were hiked at 17 consecutive Fed meetings. Rates quintupled, and gold bullion was up 55% from June 04 to June 06. There have been 7 rate hike cycles since the gold window was closed, and in 3 of those cycles, gold appreciated considerably, and in one of those cycles, gold depreciated considerably. So establishing the fact, that gold bullion has done well on an absolute basis, and just because the Fed is embarking on an interest rate hike cycle does not necessarily mean that gold bullion will suffer. And in fact, moving on to slide 9, we are in another rate hike cycle, which started in December of 2015. And as you can see on this slide, the Fed has been increasing rates, and it just so happened that in this recent cycle, gold bullion bottomed in December of 15. So that is a little bit of a discussion on how gold bullion has performed on an absolute basis. Moving on to slide 10, this details how gold bullion has performed on a relative basis. And you can see over the years that gold bullion has sort of been all across the map. These returns are in US dollars. But if you look at the 10-year annualized returns, I would characterize as gold bullion having performed fairly well on a relative basis. But this is also, it's important to keep in mind what gold bullion's role in a portfolio context has been historically. And that has been one where it is an asset that is uncorrelated. It is an asset that has historically mitigated risk on a portfolio basis, and a bit of a, for lack of a better description, an insurance policy. And I would argue that those 10-year returns are fairly remarkable for an asset that has those types of characteristics. Currently, we are in a market where the investor has become risk complacent. 9 years of a general bull market, I think, has done this to the typical investor. They no longer are thinking about the risk of their portfolio, but rather how they can extract every single basis point that could be up for grabs. But like I said, in historical context, gold bullion's role in a portfolio, this is, I would argue, exceptional performance considering the attributes of that particular asset class. So moving on to slide 11, which details our gold investment thesis here at Sprott. It is not one based on economic calamity. We believe that gold bullion is inversely related to U.S. real rates. And if we look over the mid to long term, we think that the environment will be challenged to generate sustainably higher real rates. Real rates are driven by economic growth, and we see some significant headwinds to sustainably higher economic growth over the mid to long term. Obviously, this is very difficult to make a call in the short term. So, the first thing that I'll point out, and people have started to roll their eyes about this, are debt levels. Debt to GDP globally is at a record high. Debt to GDP in the US is north of 350%. To provide some context for that number, it's historically ranged from 140 to 170%. So we are off the charts. And I am in no way implying that we will collapse under a mountain of debt. But like I said, our thesis is based on sustainably higher real rates, gold being inversely related to that. And at some point here, capital will have to be reallocated from productive assets that generate real rates to that of paying down debt. And that is why the debt levels are a significant headwind to higher real rates on a sustainable basis. The second thing that will act as a headwind to higher real rates in economic growth is demographics. Aging populations in developed nations consume less. So this is, for the most part, not really debated. It's important to note too that something has already changed, it appears. Historically, 3% US real GDP growth has been the bogey. Above that's been good, below it not considered as good. And the last time there was 3% real GDP growth in the US was 2005, which is fairly remarkable considering the amount of monetary stimulus that has been pumped into the system. And every year, over the past few years, estimates start north of 3%, and then as the year progresses, they're walked down. 2018 is no different thus far. We see real GDP estimates in the 3% range, 3+%. We'll see how this year turns out. Maybe this is the year that GDP growth is finally in excess of 3%. Now, the one comment I'll make that's in action is what's sort of transpiring on the protectionist front. We've heard all the rhetoric that has come out of the US administration, and finally we're seeing some action on the protectionist side. We've seen tariffs on steel, aluminum, solar panels, and dishwashers. And if this continues to escalate, this will be an immediate impact to GDP. It will not be good, and in all likelihood, it will be a significant tailwind to gold bullion prices. And the reason I highlight this is because it's very tough to tell when the market will sort of wake up to the debt situation and the demographic situation. We know that is out there, but it is certainly longer term. But with what's transpiring on the tariff side, the possibility of a trade war would be incredibly negative for GDP growth and for real rates. Going back to 1990, essentially the birth of globalization, approximately 40 to 45% of real GDP growth globally has been ascribed to the opening up of borders, of free trade, so on and so forth. So this is to be continued. And the last sort of comment on the current state of affairs I'll make is with respect to inflation. We think there's a good probability that inflation is in fact taking root. We've seen it in wage data. We've seen it from executives in bellwether industries like the airlines with comments they're making with respect to their cost structures. And at this early stage, we would argue that there's a bit of a tug of war going on between Fed rate hike expectations and the impact that could have on real rates, and alternatively inflation expectations. What I will say is that if inflation is in fact taking root, in time inflation will win that tug of war, and that should be to the great benefit of gold bullion prices. Moving on to slide 12, which details how the equities have performed, because unlike gold bullion, which has generally done well over the years, the equities have struggled. And I just want to initially provide some perspective to clients with respect to where we are in the current cycle. As you can see from this slide, we have data dating to 1970. You can see that these cycles occur over very long periods of time. And late 2015, after a 4+ year bear market, the equities bottomed and they had a violent move upwards. And then in the summer of 2016, they proceeded to correct. Everyone presumed that the current bull market was over. What I'll point out is that historically in this chart, there's been 7 bull cycles. They've lasted 3.6 years on average and have delivered an average absolute return of 335%. So if that bull market that we saw in early 16 was in fact it would obviously be multiple standard deviation event away from the mean in terms of both its magnitude and its duration. And once again, trying to provide perspective, trying to get the clients to see the forest through the trees. If you go back to the late Great Bull Cycle, which started in November of 2000, stocks raced up to June 2002. And then in June 2002, the stocks proceeded to correct 40%. And in fact, in 1 week, they were down 21%. If clients had sold that local bottom, they would have left 330% on the table. So we do still think that we're in a constructive bull market. This is a very short period of time. The stocks have been consolidating. Time will tell. Moving on to the next slide, slide 13. We think that right now the equities offer an exceptional opportunity. The equities are what I would describe as a deep value opportunity. And this is very unique with respect to gold equities. Historically, gold equities do not offer any fundamental value because there's always been a scarcity value associated with them, because clients have wanted to own them for those characteristics that I mentioned earlier: an uncorrelated asset, a bit of an insurance policy. But we're in an environment that is really characterized by great complacency. I describe the current market as purgatory. There's no bears, there's no bulls. I believe that a lot of the speculative capital has been redirected to things such as marijuana, blockchain, etc. We have multiple names in the portfolio in the mid to small to mid cap space where free cash flow yields net of capex, which is a more punitive measure of cash flow, we're seeing free cash flow yields of north of 20% in 2019. This is truly exceptional. To try to hammer home the point of how the value has really improved while sentiment is completely disintegrated, slide 13 details the free cash flow that's been generated by the component companies of the Huey Index. The Huey Index has the longest history. It's the New York Stock Exchange Gold Bugs Index. And you can see the free cash flow numbers that have been generated by the component companies from year to year. 2016 was a record high year. And in fact, we expect 2017 to be higher. Those numbers will come out soon. And if you look back, you can see that the year that was closest to 2016 was 2011. The stock index in 2011 was 3 times higher where it is currently today, despite the fact that the companies in the index are generating higher amounts of cash flow. So it truly is, and like I said, an environment that's characterized by poor sentiment, despite the fact that fundamentals have been improving. Moving on to slide 14, where we discuss valuations further. Price to cash flow multiples. We have data going back to 1997. You can see we're well within the lowest quartile. And then really remarkable, gold equity to the gold bullion ratio. We have data going back to 1970. We have 47 plus years of data. We are in the lowest decile. And in the 47 years, we've seen valuations cheaper on only 3 other occasions. So how do we think this situation could get resolved? Moving on to slide 15. I'll just this is the last slide on sort of the fundamentals and what we're seeing, and then we'll describe how we're positioned. You can see this isn't a peak gold slide, so I want to be very clear. What's happened here, this has been a consequence of how the industry reacted to the gold price correction of late 2012 and into 2013. Cost structures had gotten out of control. Companies were hemorrhaging cash. And in 2013, they decided to batten down the hatches. They cut exploration teams, reduced exploration budgets in many instances to 0, suspended development projects. As fundamentals improved through 14 and 15 and cost structures became got under control, companies once again had to start thinking about growth and what their businesses were going to start looking like out 5+ years. And for many of the big companies, they are seeing declining production profiles. And that's because, in many instances, mines take many years to get to the state where you can actually begin to produce them, whether it's because of the amount of work required to actually prove up resource models and develop mine plans, and obviously permitting being one of the biggest hurdles that adds many, many years to a production horizon. Because of this, we do think that there will be a continued theme of consolidation within the space. We've already seen a lot of consolidation. Obviously, this is contingent on stability in the gold price. But just to give you an example of some of the transactions we've seen, you go back to late 15, Kirkland Lake and St. Andrews. You also saw Kirkland Lake and Newmarket, Tahoe and Lakeshore. Goldcorp took out Kaminak. We saw Silver Standard take out Claude. And then late last year, we saw a flurry of activity. We saw El Dorado take out Integra. We saw Alamos take out Richmont, and we saw Centerra take out Arico Metals. And that's just to name a few of them. So this has been occurring. We believe it will continue to occur. I'll speak to both slides 17 and 18. Slide 17 details the performance and our top positions at the end of 2017. And, it should become fairly apparent to clients that, especially if you contrast our strategy, we are very much focused on the smaller to mid-cap names. We believe those are the names right now that offer exceptional fundamental value. As I mentioned previously, we think there will be a continued theme of consolidation. We think that these names really are best positioned to benefit from this continued theme of consolidation. And our portfolio is very much positioned to reflect that. So in summary, with respect to positioning, what I'll highlight is that if you contrast our positioning to a number of our competitors, we are focused in those names that we think will benefit the most from a continued consolidation within the gold space, i.e. we continue to overweight relative to our competitors the smaller to mid-cap names because they are so compelling from a valuation basis and are possible consolidation targets. So moving on to our final slide, which summarizes the presentation and provides some details on our outlook. As we commented in 2017, gold and silver pricing was quite resilient despite the fact that the Fed continued to increase rates, and also despite the fact that we saw some fairly robust economic data and some anticipation of further economic growth as a result of Trump's tax cuts. With respect to some of Trump's economic policies, we do not expect them to be as stimulative as promised. The tax cuts are going to dramatically reduce government revenues, and the upcoming infrastructure spending initiative will certainly add to the fiscal burden. Even though we have demonstrated earlier in the presentation that gold prices can continue to rise even when the Fed is increasing rates, as a side note, we do think that it will be difficult for the Fed to continue on a path of sustainably higher rates, considering the higher debt burden and obviously what that will mean for interest rates. As we commented, we're starting to see early signs of inflation taking root. That story certainly will be continued as economic data continues to come to market, but this is something we're keeping a very close eye on. And finally, these 2 points go one in hand. Gold equities currently represent a deep value opportunity. As I mentioned earlier, there is a complete lack of interest. The market is characterized by a high degree of apathy, and we think that we have positioned the Sprott Gold and Precious Metals Fund very well to capitalize on any potential re-rating in the equities, which could be forthcoming once investor interest is renewed. And we'd like to take this opportunity to thank all our unit holders and thank you for listening in. And we look forward to seeing you in the future.